Welcome to today's One Beer Market Update from the Western Producer Markets Desk. My name is Ranulf Glanville. I'll be the host today. So I'm very pleased to have you with us here this afternoon. And I will be joined by Jerry Klassen and Bruce Burnett. So Jerry, if you wouldn't mind saying a few words, we'll jump right in with livestock.
So I'm Jerry Klassen. I've written for the Cattleman magazine for about 25 years. And recently started this last year writing for the Producer, the cattle feeder cattle comments, more specifically the feeder, focusing on feeder cattle, not really the fed cattle, because the fed cattle, feedlots, the finishing feedlots, that's a smaller group, right? And so there's a lot of questions about how the cattle market is developing, what's driving the cattle market, the demand for beef and also for cattle, and also, some, other non-price issues. I always start the presentation just kind of reminding people about non-price issues. We're always one border or one virus away from having our border closed, right? It seems like now we have the New World screwworm. It started in Panama. It slowly moved north to Costa Rica and Nicaragua, the Central American countries, and now it's in Mexico. Now it's only one above Mexico City. It's moving north. And so that's probably not going to stop. We're probably going to have some issue here in the future with this New World screwworm, because when it was in Panama, people thought that it would be there, it would stay localized and contained, and it never did, and it's slowly moving farther north. So that's something to watch over the next 6 to 8 months, how things develop, because it can seriously affect the cattle market. But, and also if borders start to be closed, it's important to note that Western Canada, we imported about 400,000 feeder cattle last year, mostly Holstein Holstein crosses, right? So it's fairly significant for domestic feed demand. So there are two main factors influencing the price for cattle and beef. And one of them is consumer income. When I started analyzing the cattle market, then an old-time cattle feeder came to me and he said, if you want to be a successful analyst for cattle, you have to analyze the average, the disposable income for the average American, because that's what drives beef demand, okay? Now, the second characteristic is that beef demand is inelastic. That demand curve is very steep. People eat the same amount of beef every week, for the most part. And so the price of substitutes and other things doesn't have much of an influence on beef demand. And another important point in regards to that demand curve is that a small change in supply has a large influence on price. So when you're looking at beef and cattle, it's consumer spending or disposable income. And then the second factor is the beef supply, because a change in supply has a large influence on the price. Small change in supply has a large influence on the price. So we have to look at periods in the U.S. economy where consumer spending was expanding or growing. And when I start off with a price chart here from 1969 to 1983, and there are 4 phases to the business cycle. The first is the economy contracts, then there's the trough period and recession, and then there's the expansion, and then the peak. Okay? Now, during a recession, we have high unemployment, and what happens is the Federal Reserve lowers the interest rate so that it enhances consumer spending. It enhances, people get loans, the money supply loosens, okay? And so then people start to spend more money. And you can see the first period here, I have the trough to the peak business cycle pointed out on the cattle, on a live cattle chart. And the first example is from November 70 to November 1973. Now, prior to the recession, interest rates are at highs. Like in 6 months before the recession in November 70, they were about 12%. During the recession, the Federal Reserve drops interest rates to about 5-6%, and then as the economy starts to strengthen again, they increase interest rates. So by 1973, interest rates were back up to 13%, and you can see then the cattle market starts to decline, right? Consumer spending starts to contract or slow. The second example is March 75 to 1980. Now, prior to about 6 months before 1975, interest rates were about 12-13%. Now, again, during the trough of the recession, the lowest point of the recession, they dropped interest rates to about 6%. And then 1977, they started increasing interest rates. The cattle market started, increasing. And in January of 1980, some of you can remember, interest rates peaked out at about 20%, 21%. And what happened after that? The cattle market starts to level off and go lower. Okay? So you see that pattern happen. Now we're on to our current situation. Okay, now and notice that March, 1975 to 1980, I can point out periods in the 80s and 90s. It's always around 5 years. In June of 2009, again, interest rates went down to zero or very low. The Fed rate was down to zero, and then the economy started to expand, and the cattle market peaked in October of 2014. The cash market actually peaked in the spring of 2015, but the futures peaked in the 14. Okay. Now this last recession we had it in 2020. So again, using about that 5-year period, we're kind of coming up to that period where you have to start watching for this cattle market to start peaking, right? We were contracting the herd at the lower prices. Then the economy went through this huge expansionary phase here the last couple years, and interest rates went from 0% up to about 5.5% in 2023. Now last year they started lowering in interest rates, but we're still relatively near the highs, right? We haven't seen any significant changes. The economy is still growing at a pretty fast pace, or pretty good pace. We've had job growth. The U.S. has hired there's 1 million more people working since January, and wages are up 3.5%. Okay, so you have more people working, higher wages, and the population itself is up. Since the last 10 years, it's up about 20 million people in the U.S. Okay, so you have stronger demand. So we're kind of coming up to that period here where you have to start watching for the market to be putting in its highs. Now, this chart is the calf crop, the U.S. calf crop, and the Canadian calf crop mirrors the U.S. And in 2014, when prices were right at the highs, the calf crop was at the lows. Okay, so we had lower supply and very strong demand. Okay, as you go forward after that, you have a growing supply and you have a softer demand, and that results in a lower price. Okay, now we're at this period here in 2024. The 2024 calf crop was only about 35,000 head less, so it was relatively the same as 2023, and that's largely due to the lower beef cow slaughter. We haven't seen significant heifer retention yet, but the beef cow slaughter this year will be lower again, and that by itself is the first sign of an expansionary phase, but also at these levels that it's at, it's enough to encourage, or should I say, to result in a year-over-year increase in the calf crop. So we're looking for a minor increase this year. Those calves are going to come on the market next year in 2026. So we have lower feeder lower calf crops, lower feedlot placements. This is beef production, which is basically the number of cattle slaughtered times the dressed weight. That's what we have for beef production. And you can see that the first quarter of 2026 is when beef production will be at its lowest level. Okay, after that, it's going to start increasing. And so remember, a small change in supply has a large influence on the price. Okay, so we're looking for the feeder market to peak here over the next 6 to 8 months. Okay, so we're at or near the highs. I'm just pointing out the corn crop, and Bruce will talk about this as well. We have a huge corn crop coming, so the cost per pound gain for the feedlot operator is going to be significantly lower this year than last year, which gives them a little bit more buying power when buying replacement cattle. So on our projection here, I have an upside target here around $340 on the CME live cattle. If you convert that Canadian dollars, take off an $8 basis, you're basically at the cash price in southern Alberta for an 850-pound steer. Okay, so we'll probably see, we're seeing 500-pound steers now trade for almost $7 a pound. We probably have maybe a little bit more upside on top of that, but not much. I think, like I said, we're probably within about 6 to 8 months where the highs will be in place at that time.
Excellent. Well, thank you very much, Jerry. A lot to think about there if you're in the cattle business. And I'll now be handing it over to Bruce Burnett. He'll be saying a few words about crops.
Okay. So I'm Bruce Burnett. I've worked in the grain analysis, weather analysis business for far too long, but I'm still here. Anyway, so the chart that you see, or the map that you see on the screen, is the last 30-day percent of normal moisture. So how much did you receive compared to normal? You can see essentially across the southern prairies, most of Manitoba, less than 40% of normal. There's also some areas up across the north that are also less than 40% of normal. In between, like an Oreo sandwich, the good stuff is. So basically, I did a bit of a crop tour getting to Saskatchewan. My GPS didn't work too well. I ended up in Alberta and whatever, and then I came back here. But anyway, this sort of bears out. Now, the conditions in Manitoba on the map are probably a bit overstated. It's not that bad. The crops are in good condition. They need some moisture. But that you could say about anywhere in the prairies. They need moisture. Over the next little while here, are things going to start to go downhill. The good news is that crops are in reasonable condition in most of those areas. The areas where the crops really have suffered stress this year are from south central Saskatchewan into extreme southern Alberta. Those areas, the crops have been stunted, poor growing conditions. It's basically in the durum crops in those areas, not great stands, short crops, very small heads, low yield potential in those areas. The lentil crops in those regions look better. Lentils have withstood it a bit better, but they still need moisture. They don't get moisture, the lentil crops aren't going to be all that good in that region as well. So if you take a look at sort of what the yield potential is of the durum, because this is primarily a durum area that I'm talking about, we're probably going to be down 2.4, 2.5 bushel an acre from last year. So this year in the spring, we decided we were going to plant more durum area because, you know what, that's a good choice, crop choice, and it was. But we're going to lose that all in yield. So basically, the durum drops 400,000 tons from last year. Excuse me. So that puts our production around 5.5 million tons. We've had a good export year for durum. Stocks are relatively tight. So I'm looking for some sort of positive price action in durum over the marketing year after we get this crop harvested. If we have any problems in terms of quality, those types of things, that could even change the situation a lot more. The only caveat on that is that that's about the only grain that looks positive this year in terms of pricing. I said grain. I didn't say the other crops yet. Basically, for the wheat market, again, spring wheat's growing a little bit more to the north. Got a very wide spread across the prairies, but we're looking at wheat coming in. I'm estimating yields be pretty close to last year. We planted less spring wheat, so again, our production's going to drop a bit. We've had really strong demand for wheat. This is going to be the second year in a row where we're going to set a record export on spring wheat from Western Canada. You wouldn't know it. You would say, oh, prices have done nothing this year. But what it is spring wheat is in demand. The U.S. is, in terms of classes of wheat, CWRS and HRS in the U.S., that's where the demand for North American wheat has been. So we're seeing relatively strong export demand. It's just that the other wheat markets, the winter wheat markets, lower protein markets, just not performing all that well. And this is where corn will come into play a little bit later. Out of the crop that we grow up in more in the northern areas is barley. Barley yields actually look to be a little bit higher this year than they were last year. I'm assuming that we're going to have a better finishing conditions this year. The weather forecast out the next 2 weeks, 3 weeks, looks to be mostly average temperatures and increased chances of precipitation. It's not going to be general precipitation, but a lot of scattered precipitation. That's miles and miles better than last year when what we got was blast furnace conditions. And so we're anticipating the crops are going to have a little bit better finish there. So barley production is going to increase a little bit. Price-wise, this is where the corn market comes into play. Jerry said there's a big corn crop on the way. My current estimate for U.S. yield right now is 189 bushels per acre. That's going to give us a carryout somewhere between 2 and 2.5 billion bushels of corn this year. The U.S. has started trade wars that basically are going to limit their export markets for a lot of commodities. The one export market that they still have is southern central Alberta, Manitoba, southern Saskatchewan, because that's where there's going to be a lot of corn move up just because of price. My forecast for December futures harvest lows for corn are around $3 a bushel. So we're currently trading the Dees up around just a little bit over $4. So we're going to lose probably $1 a bushel in corn over the next 3 to 4 months. So that's really not good news for the barley market, and that's certainly not good news for the wheat market as well. And the reason is because we're at pretty wide spreads between wheat and corn already. So if we lose $1 a bushel in corn, wheat's going to follow to some extent. So anyway, so we're looking for a flat to lower wheat market mostly. I would say the one thing that we have for wheat is that really we're not oversupplied right now in world wheat. We're going to produce a little bit more, but our ending stocks aren't huge for wheat. We do have some weather uncertainty left. Argentina and Australian crop in Western Australia is looking poor already. And, again, they're just into their planting season. So that's saying a lot. But basically, I would say that their crop's going to be down 5 to 7 million tons from last year. That should provide some underlying support for wheat. But as we are right now, the Black Sea is harvesting, Europe is harvesting, Southern Plains in the U.S. is harvesting. Those crops look fairly good. So we're just seeing a lot of harvest pressure in the world market right now. But as I said, spring wheat demand is strong. So after we get through our harvest, we should possibly see some support for spring wheat there. The question will be is how low corn goes and how long it stays down there. Okay, the last crop I'll talk about is canola. So canola's a bit variable this year. Again, mostly grown in the central and northern areas. In those southern areas, there were some canola crops, and they, let's just say we shouldn't talk about them. Basically, in the central and the north, conditions are good. We got off to a dry start, so there's a lot of variability in the canola crop, a lot of poor establishment in some areas if you planted early and missed the moisture or whatever. But at the end of the day, with improved conditions for filling the pods up, I think it's going to give us a decent yield in canola. We'll probably end up where we were last year on canola yield. Again, canola is a lot like spring wheat. We planted less area, so therefore our production is going to drop on canola. Now, here's the good news about canola. It's relatively undervalued right now, and it should probably trade mostly between $700 and $750 a ton on the ICE exchange. So that's the good news. The bad news is we have tariffs all over the place that are being talked about. And as soon as we hear talk of the tariffs, then that just moves the markets like a yo-yo. So, back in February, we first heard about the Chinese tariffs being implemented. We dropped the contract $100 a ton, over $100 a ton. So that's the kind of volatility that we're looking at this year. In terms of canola demand itself, my opinion is that I don't think there's going to be a Chinese tariff on seed. And as long as that happens, our export demand is going to be strong. China accounts for just a little less than half of our export demand for canola this year, and we need that strong demand. The reason I don't think it gets implemented is I think they need the canola for their crushing industry because they need the oil especially. Second thing is the U.S. Are we going to get tariffs on products? So if we got a tariff on soybean oil, soybean meal going into the U.S., that just means our crushing industry is going to grind to a halt. Again, they won't shut the plants down, but demand will come down, their bids will be dropping dramatically. So it's just something to be aware of. Again, I don't think that's where we're going to go with the U.S. I think we're going to have a base tariff of some type, and it's not going to select agriculture commodities at all, maybe. So I think that's something to keep in mind. I don't view this tariff thing as a base concept, but just in your marketing plans, be aware that all it takes is a tweet. All it takes is an announcement overnight from China, and you could see the thing drop $100 a ton over the next few trading sessions. My advice on that is when we see the market rally in canola and we get up into that upper end of the trading range I was talking about, probably a good time to market some of it because you're carrying a lot of risk if you're carrying inventory of new crop, through the marketing year. Just be aware of that. Vegetable oil demand is strong. The demand is coming from the biofuel sector, both in the U.S. but also offshore. So that's keeping oil prices rather elevated. Soybean oil's trading 54, 55 cents a pound. And as long as that's there, canola should not be trading under $700 a pound for any, or $700 a ton for any extended period. Yeah, I'd love it to be $700 a pound, wouldn't I? Anyway, so that's the outlook for the major crops that we have. I'll just briefly touch on pulses. The one Chinese tariff that's hurting in terms of the grain and oilseed pulses industry is peas. There is a tariff on peas. China is our largest customer. We are, my pea yield is up from last year, and it's a good-looking pea crop, so we're going to have lots of peas this year. But again, our major market's going to be shut out probably unless we come to an agreement. So that's going to mean tough time for peas. So again, it's going to probably follow the grains market a little bit, just sort of flat to down through most of the marketing year, which is not good news. Lentils, just a little bit different. We've got a different component mix there. But again, depends on tariff rates and import amounts or allowances that India will allow into the country, because again, that's our largest trading partner for lentils. So that's it. I've talked enough, and we'll turn it over to get Ranulf.
Yeah, well, thank you everybody for attending. If there are any questions for Bruce and Jerry,